If you're investing for retirement or wanting to build wealth in the stock market, what I'm about to reveal could be the difference between crushing it in 2026 or watching from the sidelines while others make some serious money. Goldman Sachs, probably the most respected investment bank in the world, just ask Goldman Sachs, they'll tell you, just unveiled what they're calling the most important trade for 2026. And it is not the tech stocks everybody's talking about. We're talking about a completely different group of AI winners that are flying under the radar. Now, of course, they're not publishing that report for you and me, because why would they care about you and me? They're sent it to the institutional clients, the guys with the big money, right? The guys with the 9 figures, the 10 figures. But I think that we deserve the same information. And I've got Winston back there. He's got very good connections and he sniffs out these kind of research reports. So we're going to share it with you. I'm going to break down every single one of these stocks. And these are companies whose profits could grow tremendously, 25% on average, because of AI. So by the end of this video, you'll have the complete Goldman Sachs AI productivity stock list, every single stock ticker that they're looking at, that they're recommending. We're also going to look at why those companies, and we're also going to look at the stock charts together, because I think that's always incredibly important to get the risk factor right. So my name is Felix Prehn. I'm an ex-investment banker. That back there is Winston, who's you should thank for sniffing out the research. And I understand a little bit more about how these institutions position themselves, because I used to work for an investment bank. And since then, I retired. I started the Goat Academy, where we've taught about 20,000 students. I co-founded Trade Vision. It's the very tool that we use to get all of our data, all of our news. I'm going to show you what we do with that when we look at all the stock charts. And my mission is very simple: to spread financial freedom and education and joy to more people, because it's an incredibly satisfying thing to do. And if you're thinking, well, why are you really doing it? Well, there is a selfish element to it. When you've got nothing to do, you lack fulfillment. And it's a good problem, but this has been the most fulfilling thing I've ever done. So thank you guys for building this community, for being part of it, and for letting me do this weird thing here, which is just teaching people about weird technical stuff on the market. And then I love you guys who are taking action and implementing it and really like making a success of it, because that's the most satisfying part for me. So let's jump into the big picture here. Right? We've had 3 years since ChatGPT launched in November 2022, and it's changed everything, right? The first wave made some people rich, but a lot of people also were just a little bit late to the party. So I'm talking Nvidia, Microsoft, all the big tech stocks, right? Incredible runs. And basically the S&P 500 is now an AI bet, because it's like 36% or something is now the big AI stocks. But everything's just changed. And if you look at what's next, what Goldman Sachs is talking about, they create these stock baskets, and you can't trade those because you don't know what's in them. So I'm going to tell you what's inside of them, so you actually have the same access to what their institutional clients have. So they create these tickers, and then it's basically a tradable instrument, but only for their customers. It's incredibly, well, good for their customers and a little bit less good for the rest of us. And then looking at stocks that have underperformed, but where the smart money is positioning for the freaking bounce because of AI. So these are value plays. And the Goldman's trader who wrote the note, he literally said, this is the most important 2026 trade. Not exactly sort of casual, cagey language from Goldman Sachs. And what they've done is they've surveyed their own investment bankers about their corporate clients, and 37% of them are already using AI right now. That's going to jump to 50% next year, and then to 74% by 2028. So we're still pretty early, right? We're still only here. That's going to double, and therefore there's still a heck of a lot of potential money to be made. Now, this is not financial advice. I'm not telling you to buy these specific stocks. I'm sharing with you research that I was made party to thanks to that big nose back there. And I hope it's going to be educational, illuminating, and if it's going to be of value to you, maybe share it with a friend or two. But I like what Goldman's have done here, because they didn't include the sort of random consulting companies and all the sort of peripheral AI companies. No, they wanted companies actually using AI, not just talking about it, actually doing it. And that's where the potential is. According to Wharton's research, generative AI can give us productivity gains of 10 to 55%. And I completely agree with that because I use it in all my businesses and it's just insane. We can like literally do what would have taken us 2 weeks in about 2 hours. It's just extraordinary. And the big guys are catching on to that. So we're going to start with some industries. I'm going to run you through the stocks. And then after we've run through all of them, I'm going to walk you through the stock charts. Now you can download also the workbook. There's a workbook that comes with this video because there's a lot of stuff in here and I want to make sure you guys get the most educational value out of this. That's also free, by the way, and you can get access to that in our free community. More than 10,000 people are in there already, which is super cool. We only launched it like 3 weeks ago. At felixprehn.com/research resource rather. There's a link down below in the description. Just click on it. But banks and insurance are not the most sexy thing in the world, right? They're boring, right? But stick with me for a minute because what's happening here is actually revolutionary. Banks are perfect for AI. They process millions of transactions, they have mountains of data, and they do tons of repetitive tasks. So every efficiency gain drops straight to their bottom line, their profits. And they can use AI for coding, fraud detection, credit decisions, collections, marketing, underwriting, and they can reduce headcount while maintaining their service standards. So who are not great for the employees, obviously, but, well, if you are an employee of a bank, more reasons to own bank stocks because the likelihood of you getting made redundant is relatively high, unfortunately. So you're going to want to make sure you have your plan B set out, right? Harsh, but true. So what have we got? We've got JP Morgan Chase, the granddaddy of banking. Now, they had AI expertise before this whole AI boom. So they're not about theoretical stuff. They actually want tangible results. They're using AI already to reduce headcount growth. So they grow their revenue, but they don't need to grow their staff in line with revenue. So what happens? Your margin improves, right? Very simple. Then you got Bank of New York Mellon, ticker symbol BK, and they built something called ELIZA 2.0, which is like an AI assistant. They literally have 117 AI solutions in production. They have 100 digital employees. Those are AI agents that handle business leads, code writing, payment processing, client onboarding, reconciliations, accounting. So those digital employees are literally working alongside human staff. So you have 100 workers you don't really have to pay, who never sleep, who never bitch and whine about anything, and they cost you almost nothing. Now, what you're going to see, and this might sound like science fiction and weird, these banks are going to end up with 10,000 or maybe 100,000 digital employees. So the digital employees are going to go up and the real physical employees are going to go down. And it's going to do what? It's going to make them tremendously more profitable, right? So yeah, you can say it's incredibly unfair for the employees and all that, and I get it, it's going to be terrible for the employees. But you're in a position to see it early, so you can take advantage of it, or you can go moan about it, right? It's happening. Whether you like it or not, it's happening. So why don't we take advantage of it? Why don't we profit of it? I'm not saying you should buy BK stock. I'm just saying understand this, right? And then we've got mortgage companies. And this is a good example. RKT here, it's a mortgage company. They have a pipeline manager that ranks leads and then increases their conversions. They have an agent that reviews all the purchase agreements. It reduces processing time by 80%. Places the lawyers. No one's sorry about that. They have an underwriting agent that reduces completion from 4 hours to 15 minutes. So the physical humans in there, the team members, are now handling 63% more loans. Same people, 60% more productivity. What does that mean? Well, it means RKT is going to make more money. Shareholders will be happy. Right? Now, let me give you a few more, and I'll do this in rapid fire because otherwise this video will be forever. Citibank, 180,000 employees are using AI tools. They're launching agentic AI pilots everywhere. So the 180,000 employees are going to go down, and AI agents are going to go up. That's just the way it works. Bank of America, that Erica platform handles 2 million daily customer interactions. 2 million, right? Crazy. And they're only handling 700 questions. That'll be 70,000 questions in. And then you got Morgan Stanley. They've developed something called DefGen AI and Lead IQ. Basically, it's a lead distribution machine. It matches advisors with clients. So they're seeing huge productivity gains across the board. Now, insurance companies, I promised you some of those too. AIG, they have built something called AIG Assist, and it basically handles the underwriting and claims. It automates tons of that boring, unstructured document analysis, and it just makes it faster. You've got Neptune, another insurance giant. They're now an AI-first company. They do everything with AI. Underwriting, quote conversions, renewals, everything. And the insane part is they're bringing in $2.5 million per employee now, of which 1.5 million is profit. Well, EBITDA profit. Sorry, Charlie Munger. That's crazy, right? Most insurance companies generate a fraction of that per person. So it just shows you that AI can make you tremendously more profitable. There's another bonus one in here. UWM take a huge number of AI calls, closed 14,000 loans. So literally AI calls you. It's kind of a weird world, isn't it? Are there more? Yeah, there are a few more. Ally is another one you might want to look into. They've all rolled out Ally AI for all their 10,000 employees. Helps them cut down their expenses. There is BFH. They have 200 machine learning models already. They handle like credit collections, marketing, fraud, all that stuff. And you know, we could obviously go down the list some more. But I think we should jump into a different sector here to keep this a little bit more interesting. Or actually, you know what we should do? Why don't we do it this way? I think that'll be more interesting. We'll now go and look at a couple of those stocks per sector, so that you understand a little bit more about them, and you don't have to jump and search around the video. So I'm going to open here the JP Morgan stock chart as Winston's curling up back there. He had a tough morning of playing with his friends and then getting eggs. He loves eggs. I don't know what it is about golden retrievers who seem to want to eat everything. And this is the JP Morgan chart here. And do we like it or do we like it? Well, the first thing I would always do is zoom out a little bit, right? So you can see it's been on a nice run. And can you see the pattern of that run? How do you see the pattern of a run? Well, the first thing is you add a line like this one here. This is the 50-day moving average line. That's the most important thing, right? Second thing you might want to do, if you want to see what institutions are doing, there is an indicator here in TradeVision called support and resistance. And you'll only find that in TradeVision because we're the only people crazy enough to calculate all the options market positions essentially, which it tells us that when we hit the resistance line, institutions are likely to sell, and we can hit the support, they're likely to buy. So it gives you a nice little thing there. So when you're really close to resistance line, you might want to think about only $2 away from it. Why don't I wait till I break through the resistance? Because very often you hit your head on it and you just sort of do that. So yeah, I'm not telling you to do that, but I'm just saying that's something to look for. But overall, what's the trend here? Well, just connect the lows. There's an overall trend, right? The highs, well, they're also getting overall higher. So overall, that looks quite good. But there's a little bit of a warning here, and that's just been the dip from last week. And that is this yellow line here, which I said again, it's the 50-day moving average line. That is it going up? Is it going down? Tell me in the comments. Topped out here, didn't it? It's going down. It's recovering a little bit, but it's not like brilliant. Now we closed above it, which is helpful. So one more day above it could be great. So this is essentially an entry point for somebody with a bit more risk tolerance, who's saying, I'm basically buying the dip. And by the way, you're never going to get that dip down there because you didn't know it was the dip. It could go much further. So buying this sort of V-shaped recovery here can be a smart thing to do if you've got a longer term horizon and your risk management's tight and your position sizing and all that kind of good stuff. And then the other thing I would definitely do is make sure you've got news alerts turned on this one. So I get, for all the stocks I'm interested in, including the ones on this list, I get news. And it looks like this. Does that focus? Yeah. So you can see the stocks I'm following, and then I get these news alerts, and they pop in live, like literally live. And we only give you news that we believe will move the stock price. So we're not giving you all the gibber and the noise and the political BS and all that kind of stuff. None of that. Just stuff that could move the stock price, likely to move the stock price, right? So there's JP Morgan. Let's look at another bank here. And what do you see here? Well, this actually looks a little bit more positive. So you have this, what I call a heartbeat pattern here. We are above the 50-day moving average line, that one there. We haven't quite taken out the recent high, which would sit at about 100 and about 113. We're trading at 111 as I'm recording this. So there's a little bit of resistance there, but overall, we've taken out this high and that high and this high and most of them. So this actually looks pretty bullish to me. Again, not telling you to buy it, but it's quite a good setup. Banks are gonna love AI. Shall we look at another one? What do we have? Another insurance company there, maybe AIG. That's one of the big boys. AIG has been on not such a happy track. So what do you see here? Well, you still actually see that heartbeat pattern, but rather than break out of it in this direction, it went below it, and we went lower than the previous lows, which is not a happy place to be. Now it's bouncing off. Guess what it's bouncing off? You see that indicator we have, that support indicator we have? That's the $75, and we actually bounced off that. Coincidence? Well, you be the judge of that. So sort of the dip moment, right? But we are below all the moving average lines, so it's a very high risk dip buying proposition right now. But yeah, I leave the risk side up to you, because obviously I can't cover that here. What's the next stock on my list? Yeah, let's move on to the next sector, retail, a little bit closer to most of us, and this is where we see AI making a huge impact. But most importantly, it's where we see margins getting supercharged. So the big retailers are using AI for personalized shopping, AI-powered search, and customer service. But they're also using it for supply chain optimization, inventory management, and all the internal bollocks they've got going on running those very complicated businesses. Retailers using AI are seeing a 10 to 30% reduction in logistics, operations, and marketing. So the goat of that sector, of course, is Amazon. It's literally everything is AI. They're building an entire AI stack. They have AWS, which is their cloud business. They're building custom chips. They're building their own AI hardware. They have AI agents, things like Agent Core and Strands. They automate everything. They have a shopping assistant now called Rufus. Winston, one of your friends? And it helps you find products. AI across their advertising, their operations, their commerce. So they're literally building an entire AI stack. And then you have Walmart. They have 4 super agents. So they build Sparky, which is a customer-facing sort of shopping thing. It helps you discover products, you buy more. Then they have Associate, which is for employees, for like scheduling and sales data and that kind of stuff. Then they have an advertiser agency, which manages campaigns and marketing. And then they have a developer agency, which basically just builds all the stuff in the back end out faster. So they basically built an AI employee for each major function of their business. And again, it's showing good results. Do we have some more? Yeah, there are some surprising winners that you probably wouldn't think about. You have storage company. They literally reduced their labor hours by 30%. Crazy, right? Another warehouse company called Line. It's the ticker symbol, L-I-N-E, Lineage. Huge productivity improvements that they've reported. This is all from the earnings reports. And then you have Target, which undoubtedly you're more familiar with. They use AI for forecasting. So they have more accurate, less time, ends of plans across the whole organization. And they basically want to this is how employers phrase this. They say, we want to free up team members to focus on customers. Well, we want to free up team members so we can have less people we need to pay. That's basically what they're saying. But they're getting AI at the moment to do all the boring stuff, the stuff that the humans don't really want to do. There are some others in this sector. I put them on the bottom of the screen. Low, HD, WSM, WBBY, TSCO, DRVN. Just write those down. We're not going to look at every single one of them. But let's look at 1 or 2 of those charts just so we have some good data here and give you guys a more well-rounded view. Because one is always story and fundamentals, and the other is always, well, is the Wall Street money following this trend? So when you look at this chart, what do you see? Well, the first thing I would often do is look at the lows, right? These are the lows. What do you notice? Well, these two are the same, right? They're the same. And then this one's a little higher. That's good. Now, what about the highs? Here, there, and then you got this sort of beautiful breakout up there. So we're a little bit below all of them. So there's going to be some resistance as we move up towards these highs here, right? Why? Because there'll be some people who bought here and they're going to sell when we get there. Not a lot of people, but some people. Right? Most people who own Amazon stock have made money. It's pretty hard not to, but there'll be a little bit of resistance. Institutions are sitting at $235 to sell, but overall, this is actually a really nice pattern. And I tell you why, because it is the thing that makes my heart skip a beat. It is the heartbeat pattern, right? Roughly. Now, what do we want to do? We want to break out of that. So you can take two views on this. Either you take that high there, which would be at about, I don't know, just under 240. Let's call it 240. That could be the entry. Or you be more conservative and you say, no, I'm going to wait for the highest closing price up here, which would be about $250. Right? Neither is wrong. Just depends on what your risk management looks like. But I think it's a brilliant business. That's what I'm saying on that front. Doesn't mean you should run out and buy it just because I think it's a brilliant business. But we like it. Walmart is actually also a brilliant business. And what do we see here? It's actually a much prettier chart. So you had your heartbeat thing going on here, right? And right now we're at the exact point of the previous high. So there is very little resistance here. This actually looks very, very good. Now resistance for institutions sits at $110. We're trading at $109 and a few cents right now. So you could ask yourself the question, do I wait the extra 80 cents so I can get out of this, stuckness thing? But this is a nice upward pattern. And people always say, oh, it's too late. Therefore, no, stocks that go up actually tend to go up more. Now you can obviously look at is it outperforming the sector and so on? Well, a little bit. Not tremendously, but it's outperforming sector a little bit. It is a nice uptrend here compared to the industry. So again, that's an indicator which tells you how is the stock doing against its competitors. It's called MRSI. Again, something you only get in Trade Vision. So get yourself a trial to Trade Vision, my friends. It's free, the trial, and it's Black Friday, so it's like insanely cheap. So check that out. Should we look at one more? Let's look at one more. Let's look at Target, for example, TGT. And what do you see here? Well, you see a stock that's suicidal, right? Fairly strong suicidal tendencies since 2021. It's down 65%. But buying and holding stocks forever works really well, apparently. What? Right? 3 years, minus 65%. How much is the S&P up the last 3 years? Probably about 65%, right? So you're down, you're just down, like forever, basically. So what do we see here? Is this the bottoming out part yet? No, it's too early. It is still too early. But what I would look for, let me just tell you briefly what I would look for. This yellow line here needs to start bottoming out. It needs to start curving up. I would say you, at the very least, want to take out the recent high here, which is at about $98. And if you're a bit more conservative, you're going to want to take out that zone up here as well, because those bag holders are going to jump ship like rats fleeing whatever. So that's at about $106. Those would be my 2 points if we get into Target. That doesn't mean I wouldn't want to add Target to my watch list. No, I actually would, because it's made a really nice rally. Earnings have been good. These kind of companies will benefit from AI. So something to look at. Now, what else have we got? So we looked at e-commerce. Another really sexy sector is transportation. What's transportation? It's logistics, basically, right? Not exactly exciting, but very, 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 very important, because it is all data driven. If your logistics operators cock it up, everything arrives about a month late. Maersk reduced their vessel downtime by 30%. They're in container ships, right? Saved $300 million. So you think AI doesn't work? Well, we've got UPS down here. A lot of smaller tickers down there because they're quite a lot on this space here. Their system has saved 38 million liters, sorry my American friends, about 5 liters to a gallon of fuel, gas as you call it. So that's going to save them a lot of money. AI is also processing 90% of their cross-border transactions. Their agentic AI, which is AI really doing stuff on its own, is integrated into custom brokerage terminals. So it streamlines all the paperwork, right? That alone could save someone like UPS billions. And you see the same stuff. XPO reports empty miles reduced by 12%, diversions cut by 80%. JB Hunt reports 100,000 hours of work automated. Werner Enterprises reduces 40% cost reduction in back office. Can you start to see, we're going to see more unemployment and we're going to see higher profitability? It's going to be a really weird world where those struggling are going to struggle more and those with assets are going to do tremendously well. You see what I did there? And it's the same thing with FedEx. They have a digital twin of their entire business, so they can see disruptions before they happen. They can test everything out, route optimization, and so on. And there are a ton of others here at the bottom of the screen that I'm not going to run through every single one of them. Otherwise, this video would get silly in terms of length. But let's walk through one or two. Say UPS, for example. These are very complicated businesses. I don't know if you've ever done any logistics. I have a business where we ship a lot of stuff around the world, and logistics is always the pain. It's always the bottleneck, right? And this is a stock that has lost since 2022, again, about 60% of its value. So, you know, owning individual stocks for the long run, I personally think it's a bad idea. You want to own the market for the long run, the index, but individual stocks, you're going to be a little bit more active. At least that's my view on that. So what have we seen here? Earnings were bombastic, Mr. Fantastic, and we saw a nice gap up there, right? That's a big, beautiful thing. But then we kind of fizzled out a little bit again. The lows are still about the same, but not that much momentum here. 50-day moving average line is still moving on up. So we're going to see whether we stay above that. That's important because over here we then had got terrible earnings and we went back down. So the real question is this actually the turnaround that we want? Now, one way to assess that is follow the news, right? Make sure you know what's going on with this company. These companies are very big, they're very complex, but they have a lot of corporate clients who just use them and don't really look for competition. Stocks really underperformed. I mean, it's basically trading at 2013 levels, right? So there could be some value in there, but I still think it's a little early right now. Let's look at some of its competitors here. FedEx, for example. Now that looks a little bit prettier, right? So this is the thing you want to look for. This is literally the thing you want to look for. You see the downtrend, right? You see it bottoming out, and if you actually wanted to sort of zigzag sideways for a little bit, you want to break out of that zigzag, which happens here, spike in volume, which means institutions are buying it, and then you're rallying up, right? Very nice kind of textbook case of what you want to be looking for. And if you look at another of these, you find them. It is much easier than you think. There's another one, Schneider National, SNDR, and that's also down tremendously from its 2024 highs, 30% down. And what's it doing? Well, it's doing the heartbeat pattern dance, which is what we like. It's sort of zigzagging around here, but still on a downtrend. For me, still too early. You want this to probably be more around the $25 mark to make this the sort of sweet spot entry. Buying falling knives is usually a very painful thing to do, but a lot of these companies now have the opportunity to turn around, and Goldman's are saying, these are the stocks we're recommending. Now here's another one, healthcare, right? What's the pain point in healthcare? Well, it's data. It's physicians having to document stuff. Physicians are expensive people, right? Why do they have to fill in forms? And a lot of the admin stuff happens in the back end, and it's just not efficient. So you can improve that. And that is actually probably good. It means that physicians have more time for patients. Doctors don't have to do as much documentation, and the companies, the healthcare companies, well, they make higher margins. So it's probably one of those cases where we can all be better off. Here are a couple of those leaders. HCA, people who don't pay their bills, credit cards are bounced or whatever, they're using AI to fight it. Using all their documentation automatically. Elevance Health, they have tons of AI virtual assistants. Doximity here. 40% of their bookings are now done by AI. It was 5% last time. So imagine that. You go from 5% to 40%. You're going to need less people, right? There are two extra tickers down here that I put in, ALHC and HQY, are also on Goldman's list. But let's have a look at one or two of those charts here. HCA, right? So that's a thing of beauty, right? That's a run. That's a rally. Does that mean it's too late? No, not necessarily. Actually, stocks at all-time highs, which is a thing where this is, have a higher likelihood of going up than down. Doesn't mean you should run out and buy it, obviously, but actually, yeah, this looks pretty good. Now, the last real sweet spot entry point was here. That was it. We are, $30 above that or something. Not a great deal, but yeah, actually, this still looks pretty good. Some other ones from that space. Look at Docs. Now, that's a collapse and a half. They must have said something on earnings that people didn't like. find out what that is, read the news, it'll be on here. But this is a very, very volatile stock, right? So you see something like this with these huge gaps up and huge gaps down, gaps everywhere. This is a highly risky thing to be in. Just bear that in mind. Doesn't mean you can't be in it, but you just got to have like smart position sizing and everything else. And then I think this is last but not least, it's restaurants, which reminds me that there was a banana on the table that Winston probably would like some piece of. If you want to motivate a golden retriever, get a banana out. That's what I'm saying. Are you interested in this, Winston? I'm blocking your face with the camera. All right, sit down, my little friend. And we're going to share this one. So restaurants, yes, you have massive increase in essentially AI hostess labor, as they call it. Now, you drive through a drive-through. If you do that, first of all, please stop, because the stuff they're serving you there is intended to kill you. But the person that used to be there, you've got to do something for that. Sit down. Down. There we go. Never give food to a dog unless he's done something for it. And that's now a computer, right? It's an AI voice or a tablet or something. That voice AI drive-through stuff, the automated ordering, the kitchen automation, all the labor optimization, all of that is a game changer, because this is an industry with terrible margins. So a small improvement makes a huge difference. Here are some of those brands. Yum Brands, voice AI drive-through, SG, huge labor savings. CMG, I can never pronounce that company. Chipotle or something. I don't know how you pronounce that. Huge improvement. You have others, of course, too, like Starbucks, like Shack, like WEN. And if we look at, let's look at one or two of those. Let's look at one or two of those. Let's look at CMG. I still can't say it. On a bit of a downbeat trend here, right? Earnings were decent, actually, so watch out for that one, but it's still falling. I wouldn't touch it here. Starbucks is potentially bottoming out here. So this is exactly the sort of pattern that we look for, which is what I keep describing to you as the heartbeat pattern, right there. So highs, 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 highs. We're actually in a pretty good place. So if we break out of this zone, then good things may well happen. So it actually looks kind of like an interesting pattern. So you can imagine Starbucks of the future. There'll be almost nobody in there. The computers or the robots are going to make your drinks. They're going to clean up. They're going to do the payments, they're going to remind you, all that stuff. So very, very few people will be involved, and therefore Starbucks margins go up. And I'm sure one of the biggest pain points for them is having to have a manager in each branch, having to manage all the staff, hire them. What if they don't show up and all that stuff? Which means you need to overhire, right? That'll be a thing of the past. So for these kind of companies, which is essentially fast food, right? Fast food coffee, very simple to do. I think they're going to see tremendous margin growth. And then there's also some news on coffee import duties, tariffs might get dropped by the Trump administration, which would be very, very good for these guys. So overall, a lot of these stocks, you look at the charts and you go, well, they haven't done that well. Exactly. They have underperformed in 2025. That's precisely why Goldman is looking at them. They could have some real productivity gains, which means higher margins, higher profits, higher profit per share growth than the rest of the market. That's essentially why Goldman's is calling these out. And corporate AI spend is going to go up. So it's still going to be good for the big tech stocks because they're going to collect a lot of that money. But now we're starting to see the positive returns. So if I spend $1 on AI and I make money, well, I'm going to spend more dollars on AI because then I'm going to make more money, right? So it is going to take a couple of years to see the real payoffs there. Again, being early can be a good thing to do. Now, not every company is going to execute it well. Some of them are going to suck. Everybody's going to do it at the same time, which means the advantage gets diminished, and it's going to cost them some money to implement it initially. Those are some of the risks you want to think about. So I would look at the individual stocks with the clearest AI results. Stay on top of that, again, with the news alerts, some trade vision. Build your own baskets. Don't make it too complicated. 10 stocks or so is probably plenty. Pick a few different sectors. Don't be all in one. Again, I'm not telling you to buy it. I'm saying it's something you might want to do. You can go for some ETFs. I'm sure some AI productivity ETFs are in the works. That would be an easier way to get exposure. But basically, it will make companies more profitable. So being a shareholder at the moment is a beautiful place to be. Goldman calls this the most important trade in 2026. You want to stay on top of that stay informed, have the best data. We haven't even looked at dark pool data and all that stuff. It's all in there. Go to felixfriends.org/trade vision. Take advantage of our insane Black Friday offer, which we have never done, may never do. I'm not really a big fan of these things, but there has never been a better time to lock in some really, really crazy low prices on Trade Vision. So check it out, felixfriends.org/trade vision. Links down below, and I wish you a beautiful rest of your week. The Fed just announced the official end of quantitative tightening. That's money shredding. And that's just 1.5 weeks from now. And in exactly 2 weeks, they're cutting rates again.